twice.
I'm gonna headlock both of y'all.
Yeah. Hey, I got the camera on.
All right.
Hey, that was the Wyatt.
Oh, did you really?
That's not how the Wyatt acts on the Facebook.
Oh, I was just playing,
Yes,
guys.
that's on the,
That's
the
his
home team
Instagram.
512.
Hey, buddy.
Yeah,
I was just playing.
And it's the Wyatt Giles on Instagram.
Senior Giles.
Yes. All right. So we're going to into money. We're going to be talking a little bit about rates, probably inflation. Sounds like a great deal, and then we'll go from there.
All right.
Hello, Austin, Texas. You're listening to the Home Team with Troy and Wyatt, where we bring sports and money together for your education and entertainment. If you have any questions about anything we say today, please reach out to me at loansfromtroy.com, or you can give me a call at 855-299-HOME. And as always, Wyatt is available on the Facebook.
No Facebook.
And that's the Home Team 512. And this segment is brought to you by Security National Mortgage, where we turn houses into homes by financing
Your
American dream. Did you notice how it slowed down?
I did. I like it.
Yeah,
Hey.
yeah.
We've been doing this for a while. What, 3.5 years, 4 years almost?
It was pre-COVID. That's all I know.
Okay, yeah. COVID's has a big asterisk on it.
Yeah,
Right.
It's funny. I don't remember things in life anymore as to pre-COVID, during
Right.
COVID, or post-COVID. So
Right.
that's all I remember.
Big old-
I've timed everything. You know.
Yeah.
They were like, do you remember when the shuttle blew up? Do you remember where you?
Oh
were?
yeah, most certainly.
Yes.
Yeah.
Do you remember when 9/11 happened?
I do.
Yeah,
Most certainly, yeah.
those things you remember.
Right.
And so now, kind of COVID, it's that new
Yeah,
thing.
the new thing. Right.
Absolutely.
It
So
just lasted for 6 months. Anyway.
Well, it just ended, and that was 2.5 years later.
Yeah, fair enough.
So it's just officially over now.
Well, we were just talking about that last thing about how that affected some money and interest rates and So where are we at right now?
Well, yeah. So first of all, we want to thank our special guest. We kind of talked in the first couple segments about this, but Zach LeLeux. So thank you for showing up. We appreciate it. We don't get very many hunting sports to discuss on here, so I actually like
I love it. Yeah, and we're gonna get some more information from him. But he's also a listener.
Yeah.
Oh, yeah.
He's actually and
That's the reason I got my camper.
Yeah, that's right.
Yeah, and we're definitely going to talk about that because you had mentioned you purchased an adjustable rate, and the rates have gone up, and you're kind of like, is now the time to refinance? And so I'm just going to give you the data. Basically, the Fed has said, and they've said for a while, that they want to get us to 5.25% Fed rate. Right, we're at 5 right now. Right, and they've been saying for a while they want to get it to 5.25% and hold for some considerable time. This is where the debate comes in. All the economists, they did it too fast. They're going to crush this. It's good. It's just right. It's not. This is where this is the theorists of the economy are making all their opinions. So everybody believes they're still going to do one more quarter rate in May. Right.
Increase.
And.
Where are we at right now?
We're at 5, and so one more quarter will get us to 5.25%. That's the Fed fund rate. That's not interest rates. Interest rates are all over the place.
That's different things.
Vehicle rates are in the 8s typically. Mortgages are in the 6s right now. Credit cards are 24. They're excited. Credit cards are very excited.
They're making some money.
Yeah,
Yeah.
they're able to get their rates back up. So that's kind of where everything is now. They wanted to get to 5.25%. The problem is they moved up so fast. I mean, they went from 0 to 5 in a year, in less than a year, like 8 months, right?
Right. Pretty abrupt.
And the thing is that you have to think banks they borrow money and they loan money based off of rates, right? And so they were borrowing money at 1/4, 0.5%. Well, now they're borrowing money at 5%, but with that 1/4 or half, they were loaning it out at 1 or 2. Well, now all of a sudden they've got money out at 2%, but they're having to spend 5% to borrow it. So it's stressed a lot of banks, and we've already had 2 huge bank failures because of it. They were invested heavily in bonds and crypto
and technology,
and technology, and that segment has taken a big dive. And so you would think that the federal government at this point would take a pause, kind of let everybody kind of catch up, kind of wash out some of these low interest rate loans and push them back in. You would think that, but I don't think. I think they're stubborn about 5.25%, and so I do feel they're going to do it. And I believe personally that that's the proverbial nail in the coffin for the economy.
like in a very bad way. nail in the coffin meaning like, hey, this whole tumultuous thing is over with. We're here, or what?
Well, no, I like the straw that broke the camel's back.
Yeah,
is kind of. I think they just.
So the sky is falling. What's your?
It's a recession. The depth, the length, that it's so hard to tell. Right. Again, there's so much money. The job industry has been so strong against all this. But then they've changed the model of how they calculate it. So I don't know if the job industry is really this strong or if it's just, so we won't really know for another year until we get year-over-year numbers from the new numbers, right?
Right.
That's the problem when they change when they change how they do something. You need year-over-year to get real understanding of it.
So Zach, do you know if you need to get a new loan or not?
Well, hang on.
I'm just messing. I'm trying to put him on the spot. I'm just trying to put him on the spot. That was all I was trying to do.
So I feel, right, and so again, feelings, right, that later in the summer or next fall would be better because I think we go to 5 1/4. That's the proverbial camel, straw that broke the camel's back, and then the economy goes into a slide. And the only way they've proven they only have 2 levers: dump money in the economy or adjust Fed rate. Right? They can't dump any more money in the economy. They know this, so they're going to release the rates, which is better for the economy anyways, because 2008 to 2020, if you compare the difference of why 2008 did not create inflation and 2020 did create inflation, was because they allowed the banks to loan money out, and that was a natural growth, and we kept inflation in the 2s for a decade, and they dumped a ton of money out in 2008, right?
Right.
And so 2020, they gave it straight to you and me.
And they kept on dumping for years after that too, right? Though it wasn't just 2008.
Yes, correct. No, they
for many years after that they were dumping lots of money.
They were bailing out banks. They were doing all sorts of things. They just were not putting money into the hands of the consumer directly, and that's the difference of 2008 and 2020. That's the difference of inflation. The question is, did someone write it down in the government and put it over there by the Fed money people so that when they go to do it again in 10 years from now, they're like, oh.
Did they put that sticky note on their thing?
Yeah, they need to put like JB Weld on the sticky note.
JB Weld,
so that it stays there. Because like 10 years from now, we're going to run through the same thing.
Right.
And the question is, do they learn their? This is why we study history.
Yeah.
So that's my suggestion.
So you're about to have a term come up, and it's about to get more expensive. So should he refinance it if it's going to go up to 7.5 or whatever?
I mean, what type of asset is it?
It's a home equity loan on a house.
So the problem with doing it is that there are some expenses and things like that kind of involve. The difference between 1/4% is not that big a difference per se. I mean, don't get me wrong. That's a very relative term. Somebody's like, "What do you mean?" That's a huge. So I mean, I think it's not going to get any worse after the May. So I think that's the last adjustment. They've been talking about it for a year, so that it's not going to get any higher than after the May adjustment.
Okay.
And the odds of going down are 95%. The odds of going up are 5. I would, so I would, if I was doing it, I would gamble until August, September.
Okay.
That would be my suggestion. That's what I think too. I think the rates are going to be, back in the 5s by summertime, by midsummer. Then right now they're in the 6s, and home equity refinance is higher. So that's what I think. And once it's 12 months old, you can do it as a rate and term. Is it 12 months old?
Yes, sir.
Okay, so yes, you can do a regular rate and term now. You don't have to do a cash out. So that's a nice thing that we did learn from 2008.
Right. So would you advise him or someone who is out there listening who's in the same position, right? They're waiting on those interest rates to come down to go ahead and apply, get pre-qualified so that when those rates do come down, you're ready to go?
Absolutely. And that's what we did, when the rates were falling all over the place, we'd get everything kind of set up, and then we'd just wait and say, hey, here's the rates. You ready to lock? And then someday that magic feeling, when we call, hits, and they're like, let's do it.
Wasn't there a Saturday not too long ago that for like 4 hours it dropped down like a half a point or something crazy like that?
Yeah, and that was somebody asked if the business is better today. It absolutely is better today because it was in January, for like a week. Rates dropped to mid 5s, and we did more applications in that week than we'd done in the previous 90 days. So people are very sensitive to the rates right now, and they're moving in the right direction. At the moment, they're all over the place. Like last week they went up, the week before they went down. They're searching. Rates are searching for that spot because everybody believes we should stop raising rates. but the Fed thinks that we should keep raising rates. We didn't talk about it. The PPI, which is what I've always the leading indicator of inflation, we've been talking about that for a long time. The producer price index, it's what the people that make the widgets spend. Their inflation rate was at 2.7% last week. Huge drop off. I mean, it was like 8 months ago. It was 11.
OMG.
Yeah, and so you would think.
We did this acronym. I'm sorry. PPL. I didn't know if you didn't do it, then you'd be SOL. So I didn't know. I mean, I didn't know whether
we're not doing manufactured home. There's no statement of location fee.
Sorry, LOL.
Okay.
I apologize.
Yeah. So the PPI, which is the producer price index, the CPI is the one everybody hears about. It's what you and I spend, right? That's the money you and I spend. The consumer price index, right? The producer price index is what the people that create whatever we buy spends, right? Their inflation rate. Well, their inflation rate is in the normal, it's in the great numbers, right? But the Fed is very, they're on this consumer price rate index number, and it was flatline last month, and so that's why I feel they're going to raise that rate one more time.
Question about that with the pre-qualification, is there an expiration on that term? Like if I get pre-qualified, does it only last for 30 days, 60 days, 120?
So yes and no. It's if you're out purchasing, it's basically unless the rates move up or down a certain amount because you're no longer qualified for that amount. But the credit report expires in 120 days, and so we have to have funded your loan in 120 days. So typically a pre-qualification is around 80 days or so. After that, we need a new credit report.
Can I say it? Don't go buy a new truck if you're looking to refinance. Don't do it. Don't go get rooms to go. Don't do any of that because once that does, that changes everything up on your for your debt to income and things like that. And so if you're looking for a home and you're waiting that 120 days and you're waiting for those interest rates to come down, you're gonna hurt yourself. You go buy a car in the middle of it.
And just so you know that 0% don't pay for a year, we still have to calculate that payment.
Yeah. So just FYI, I say that we laugh because it happens all the time.
All the time.
Yeah. So
for us, we do them every day, and so it's common knowledge. But for someone that does it 4 or 5 times in their entire life, it's not.
It's like, well, I just went and got cabinets. And this, but anyway.
Hey, you've been listening to the Home Team with Troy and Wyatt. We hope you've enjoyed what you've heard. If you have any questions, please reach out to me at loansfromtroy.com or give me a call 855-299-HOME. And as always, this segment is brought to you by Security National Mortgage, where we turn houses into homes by financing your American dream. See you in just a minute.